All right, so let me start off just by saying that I apologize for having to cancel class today. I know probably a lot of you are not disappointed by that, since it's kind of windy outside, but at least it's sunny and fairly warm. Um, but anyway, I'm sure there are some of you whose schedules were messed up because of that, and I apologize for that. Um, I've probably mentioned in class I have a big family. I have 6 kids. My wife is currently pregnant. I have a lot of family commitments. And with 6 kids, the oldest 4 of which just started in public schools after being homeschooled their whole lives, um, basically everyone's getting sick all the time. Seems like 24/7, that at least someone's sick. But anyway, because of the circumstances today, I had to run and go grab a kid from school, and now back and forth taking care of various sick children and trying to take care of my wife as well. So anyway, I hate to be one to make excuses, and more obviously don't need to make an excuse if I want to cancel class, but just wanted to show you all the courtesy of telling you why that I canceled it, especially as late in the day as I did, day of class. Anyway, this is a pretty straightforward chapter. I'll go through the slides pretty quick. I have posted some practice questions for each chapter, and I will continue to do that throughout the semester. You'll notice that they are worth 0 points. You do not have to do them. They say optional on them, so please only take a look at those if you are interested in practicing. I recommend it, of course, and that's the best way to learn accounting is to practice. So I would recommend it. And then, of course, also you can take a look at when I post the quiz-like question walkthrough. You can take a look at that as well. Okay, so current liabilities and payroll accounting. When we talk about liabilities, I mentioned this, I know, at least at the beginning of Principles 1. But the basic definition of liabilities, you'll see all kinds of wordy textbook definitions, but to me, it just means you owe somebody something, okay? So if a company owes another company or an entity something, that is a liability. So you can take this visual for what it's worth, but remember, you owe money if it's a liability. So on the balance sheet, they're broken down into current versus long-term liabilities. And the reason is because typically current means 1 year. So within the 1 year time period, are you going to have to pay any money to anyone that you owe money to? If so, that money is classified as a current liability. So this has been deemed to be helpful to separate it out like this because typically an operating cycle, which is captured within the income statement, is 1 year. And so if you are comparing the health of a company, looking at past results for what has happened within a year's time period, and comparing that against what a company owes in the short term, that can be beneficial for external people looking at different company valuations. You'll also see current liabilities compared to total liabilities or compared to other long-term liabilities. You'll see all different kinds of things compared and ratios looked at. This is one of those that just helps you get an idea of, okay, well, we know how much our total liabilities are, but as a percentage of that total, how much of that needs to be paid out this next year? And how much is going to be split up over the next, say, 20 years or 30 years or however long it might be, greater than 1 year. These are some uncertainties that can pop up within liabilities, and we'll talk in a little while about how you handle accounting for liabilities that may have some or all of these different types of uncertainties tied to them. But first, we'll talk about known liabilities, and these are liabilities that don't have those uncertainties tied to them. So obviously, we've seen account payable throughout the year. Sales taxes payable. Again, anytime you see the word payable, that means you owe someone something. You're going to have to pay it. So these are all liability accounts. In addition to the ones called liabilities, you will also see are called payables. You may also see accounts specifically called liabilities. And then you will also see the one account with the word revenue in it that can be confusing, but unearned revenues, showing that these are in fact monies that you received without doing the work or providing the goods associated with them, and so you either have to pay back the money eventually or give the people or the entities what they've ordered. Here's an example of how you can look at sales tax payable, assuming you're a business collecting cash from a sale of materials. Once you collect that money, anytime it's any type of tax payable, you basically just be sitting and holding it until you paid it out to whoever was collecting that tax. So you'd be kind of just an intermediary or a fiduciary of that money. You'll notice throughout this whole chapter that basically, if you know how to deal with one liability, you know how to deal with all liabilities. And that is, when you owe money, you increase a liability account, usually that says the word payable in it. So that's a credit to that account. That's one side of the journal entry. The other side, whenever you are establishing that you owe money, is either cash because you received money from someone, or an asset because you received some other asset from someone, and you'll have to pay or provide services in the future as reflected in your liability. Then it will sit in that liability account until you pay it in whatever means you do, whether by cash or in the case, as you see in this situation where it was unearned revenue, instead of paying it, you provided the service and recognized the revenue. That is also an option. But you'll see a lot of varieties of these liability accounts under current liabilities, and I'll briefly talk about them. But for the most part, it doesn't matter what they are. I mean, you can tell by the name of them what type of account they are. You're smart people. You can figure out when you would put money into federal sales tax payable, right? Whenever you're talking about federal sales tax money you collected, or I guess federal sales tax doesn't exist, but local sales tax or state sales tax for whatever item you're talking about. So I guess what I'm getting at is don't get caught up in the names of these accounts. Most of them are pretty self-explanatory. Just make sure you know the basic operation of liability accounts and know the difference between current and long-term liabilities here. So note payable is just a type of liability, again formalized by a signature and a promissory note. This is what a transaction involving that type of liability looks like. Here we are basically swapping out our account payable for a more formal note payable and $100 cash that is kind of a down payment on that note payable. And then now, since this note payable has interest associated with it, as time passes, we will also have to pay interest. So when the time comes to pay this off, we have to pay the interest that we owe, and we also have to pay the principal. And in this case, that's what that looks like. But in operation, this functions like any other type of loan or interest-bearing device where you calculate the interest. The amount of interest that you owe and then you're paying is captured in interest expense, and that would be a debit there. Excuse me. Obviously, you want to eliminate the liability. That would be a debit there, and then cash to show the payment. Or, obviously, whatever it is you're paying with. Just an idea of what a formal note payable might look like. Again, we have another situation of a note payable. Borrowed money from a bank, you get cash. You sign a note payable, which is just another type of liability, a short-term loan. So that's what this journal entry here does. And then down here, when you go to pay it off, you recognize the interest you're paying. You calculate that interest here, and you pay off the principal. This is just recognizing that a lot of the end of period adjustments we've talked about in the past. One such adjustment is a note payable that has been earning interest, because we will want to have recognized the interest as of the day that we do the financial statements. Okay, so we're switching over now to payroll liabilities. So employers end up incurring expenses by the fact that they have employees. So employees work, so employers have to pay taxes on behalf of their employees, and then they also have to pay taxes on their own behalf because they have employees working for them. And those are where we are looking at these types of payroll tax liabilities, payroll liabilities, and other types of payroll deductions. So this is just an idea, starting with gross pay. If you have ever worked or have a job where they've taken money out of your paycheck, this is some of the various areas that money is going to. I remember as a kid not really caring about any of this stuff, just knowing that a lot of money was leaving my check. And obviously, if I was going to get some back, I would care which accounts that was coming into, obviously. But for the most part, I just cared how much money am I getting. But then now y'all are more sophisticated, so you want to know where your money's going. And obviously, as an employer, you have to know where, when you're pulling money out of the paychecks, where that money is going to have to go to. I'm not going to talk about the details of any of these FICA, any of the reasons why this stuff has to happen. As a principal student, all you need to know is, and if if you're using accounting software, all of this stuff's programmed in, and you may just have to set amounts or percentages for some of it. But basically, you just need to know that there's these various different types of deductions that have to come out, some of which you are just pulling out of what you initially owed the employee, and some of which is coming out of your own coffers to pay the government on your own behalf. So that's what all of this is. You can look at all of the individual slides explaining specifically some of how this operates or why it happens the way it does if you want, but I'm just going to focus on the accounting of it. So this is what an entry might look like to record payroll expenses and deductions for an employee. You recognize salaries expense. This is the amount that's actually going out in a check, and the rest of this will show up on their statement as withholdings that we pulled out of what we were going to pay them, and instead have sitting in basically in a separate area, waiting to be shipped off in their name to the government. Then, of course, we also have the side of that we have to pay on our own behalf. So what does that look like? Well, that looks like this. We recognize payroll tax expense. This is from our perspective. We're paying our payroll taxes, even though some of the payroll expenses that we recognize, or the salaries expense, includes some payroll taxes. those would be payroll taxes from the perspective of the employee. So now we're talking from the perspective of the employer, and that's why the debit side of this is to payroll tax expense. Okay, so again, I'm not too worried that most of this stuff you're going to have, and for principals, you're going to be given this information. And even if you were doing this for work, it would be more, do I have the right amounts plugged in so that it auto-generates into these individual accounts. So most of this is set up and done for you. And the various software companies try to, and the pitch is that they're supposed to update this whenever the information comes out so that you don't ever have to worry about it. Obviously, at the end of the day, the accounting professionals are the ones that end up being responsible for this, so you have to make sure. Okay, so again, I mentioned before we're going to talk a little bit about estimated liabilities. An estimated liability is a known obligation of an uncertain amount, but one that can be reasonably estimated. So, these are various insurance and pension benefits. If you provide these to your employees, then it's not uncertain as to whether you owe them or whether you're going to have to pay them. The only uncertainty is the amount, because that will be based on how long they end up working at your company, and if they end up retiring, what their benefits are, etc., etc. Most of the time, what ends up happening is some type of actuarial calculations are done, and these estimates are made for this type of scenario. Again, when you look at the journal entry, it should look pretty identical to the ones we've already been talking about, because we have credits to payables or liability accounts and a debit to employee benefit expense, because that's the expense we're talking about at this point. Again, vacation benefits, for purposes of principles, you're not going to be required to try to calculate vacation benefits or how they operate. You'll be given an amount, maybe, if you're even asked about them at all, and you'll just have to plug it in and know, okay, same format, debit to expense account, credit to whatever payable account it is, describing what we owe, or who we owe, or whatever the case may be. More details about what we owe. Okay, sorry about that. It's a kid coming to get me, so I don't know if you can hear any of that. Okay, let me see. Oh, hold on just a second here. Okay, I think I am ready to go again here. Play from the current slide. All right. Here we go. So this is assuming a bonus plan is getting paid out. Again, I'm not worried about you all knowing necessarily the best way to calculate that. Oh, why is not one? Hold on here. Okay, here we go. So another type of liability that you know that you're probably going to have some amount of, but you don't know exactly how much it's going to be or when necessarily it's going to be, would be if you have some type of warranty. So that would be anytime you say, okay, well, I guarantee my product's going to last for X amount of years or be fit for X purpose for this amount of time, You say if not, then we'll replace it for free, or we'll repair it, or whatever. Then obviously you're incurring a future liability, because you're incurring the liability of paying for anyone whose item breaks during that time period. So obviously you don't know how many people that's going to be, how many items that's going to be, and there are ways to ensure that you're getting a good guesstimate as to what the liability is going to be. Whatever that is, again, for the purpose of principles of accounting, you're just going to be given an amount and say, this is what we're guessing. You're going to end up having to estimate for your warranty expense. And then we recognize that right away. And then when we actually have to ship out new parts, this would be the journal entry that shows us having parts go out and satisfying our liability, or basically going against the estimate that we already put in the books. So those were liabilities that we knew we were going to have. We didn't know scope necessarily of the liabilities. Contingent liabilities would be liabilities that we don't even know that they're going to happen. So a lot of court cases, generally what we think of for these, someone's going to sue you, you don't know if they're going to win, or you don't even know, it's just possible that you might get sued. You might be in the line of work or a business where that happens very frequently. But more than likely, you've been named in a lawsuit, or you expect to be soon, and there's a possibility that you're going to owe a lot of money in the future. Well, what's the likelihood that's going to happen? Is it probable? Is it possible? Is it remote? If it's remote, then you don't have to do anything, okay? But if it's possible, meaning there's not an exact figure that I can tell you this is possible and this is remote, but it's kind of an objective standard, or I guess I should say more of a subjective standard. Anyway, if it's a possible likelihood that it's going to happen, and you are able to estimate how much it's going to be, you can record the liability. Otherwise, you disclose it in the notes. And that ends up being what you do for whether it's possible or probable. Again, potential legal claims, also debt guarantees can make that happen as well.